Good day. Welcome to another lesson on our Super Dealmaker program. We're still looking at the business plan development module, and today we're looking at the funding requirement and preparing the financial projections. We've started with, in terms of the business development module, we started with identifying the business idea. We looked at how you conduct your feasibility study, and then we looked at how you develop your operational plan, and then we looked at how you do your market analysis and marketing plan. But just to recap, the lesson on how you identify a business opportunity is based on the things that you need to do to identify a business opportunity, how you should approach identifying business opportunity. As stated throughout the program, to say not all opportunities are business opportunities. There are certain opportunities that customers are not willing to pay for or they cannot afford. So that now it might be an opportunity, but it's not a business opportunity because they might not be economical. You might not be able to take advantage of that opportunity to make profit. Because remember, entrepreneurship is about taking risks. It's about identifying opportunities and taking risk so that you can achieve economic returns from those risks that you have taken. So if an opportunity that you have identified is not economical, so it's not worth it for an entrepreneur to pursue. So that's the summary of how you identify the business opportunities. You can go and read or go through the study material and watch the video on how you identify business opportunities. Then from there we moved to feasibility study to say, once you're comfortable that this business opportunity is a real economic opportunity where you will be able to make profit, then you go into conducting a feasibility study to validate that idea, to see, now going a little bit more in detail, to investigate the market, the opportunities that exist. Will you be able to penetrate it? Do you have the resources? Is it feasible for you, given your resources, given the environment that you're operating in, for you to take advantage of that opportunity? And then on the feasibility study is the one that's going to guide you if you should continue with the project or not. And as indicated even during that lesson, to say, look, most entrepreneurs, they identify the opportunity, but they don't do feasibility study before they spend their money or before they invest in that business. Meaning that you will learn later on, after you have lost or you have already sunk capital into a project, and then you realize that, oh, this business is actually not viable. Actually, this thing that I thought is a business opportunity is not actually a business opportunity. So a feasibility study helps you with that, to determine, to ascertain if what you have identified as a potential business opportunity, is it a business opportunity? Is it economic? Will I make money out of it? Then once the feasibility study, let's say we assume the feasibility confirms opportunity as economic, that it is feasible to you to pursue this opportunity. Then you develop an operational plan. So that's how our lesson is structured. Then you develop an operational plan. So when you develop an operational plan, basically you're looking at what is the operational requirements for you to start taking advantage of this opportunity that you have identified. So you look at the infrastructure required, equipment that are required, people that are required, building if it's necessary. What is required for you to take advantage of this opportunity? Then you look at the operating model. Which model will you implement? But the model, actually, it will be feeding from the feasibility that study that you have conducted. And then depending on the customers that you will be servicing as well, based on the feasibility, then you design the operation how you want to execute the business. And with operation, obviously, you also set your mission, vision, the targeted goals, the location where you're going to put the business. You determine the infrastructure that is required. You look at the technical competencies that is required for you to execute the project. Then you summarize that. You'll have your organogram in terms of position required for you to execute the project. So that you summarize and you put it in the business plan. And then after we looked at the operational plan, then we looked at market analysis and marketing plan. Excuse me. And then with market analysis, then we because operationally you know what is going to require. So with market analysis, then you start looking at the opportunity that exists, right? You look at the market that you will be servicing so that you can find the best way to service that market. So sometimes the market, but because you've done the feasibility study, in this case, you're just trying to ascertain how you're going to service that market. Okay, so because the feasibility study would have confirmed that this market exists and this is the market that you should target. So when you're doing the market analysis, you basically now breaking down the market that you'll be servicing, making sure that you address all the possible risks that you can identify from the market, or the risks that exist in that market that you are trying to service, and you identify the strategies that you need to put in place so that you can take advantage of that market. So you do the whole market analysis. So you basically start with the industry analysis. Industry analysis basically looking at who are the players in the market, how does the industry operate, where are the trends, what is the pricing, how do they price in the market, how do they execute, how do they sell to customers. So you do the whole industry analysis. And from the industry analysis, I've indicated that you start from the top, coming down, cascading down to where you are. So what does it mean starting from the top? Starting from the top, when you're doing your marketing analysis, you look at the South African market. How big is it in the sector that first you look at the global, whatever, our GDP, and then you look at the province, the GDP and the size of the market that you're targeting. Then you come to the municipality, or you come to the local, or maybe you come to the district. From the district you come to the municipality. From the municipality you come to the suburb or the area that you're operating from. So depending on how you are approaching the market, your market might be for the area that you are operating from. If let's say you're setting up a spaza shop, so you'll focus on the value or the economic value from the market that you're servicing, which is your local community. But if you are setting up a mining operation, let's say you mine coal or whatever, the platinum, then you will not be servicing the markets that you're operating from. So now that information is not important in terms of the market analysis, because you will be mainly selling your output nationally, or you'll be exporting. So if you are exporting, you just have to look at the global consumption. You look at the South African consumption, and also you look at how much is produced from South Africa to service that market. So your local data in terms of the consumption is not important to you, because you're not necessarily selling jewelry that is consumed by end users or by individuals. You are selling a raw material. You might have semi-processed it to a certain point, but now that's your product that you're selling. You're actually selling it to corporates, and mainly you will be exporting, because South Africa has got a limited capacity to beneficiate. So when you're looking at the market study, you are looking at the global market rather than looking at the local or provincial market. So that's how you do your market analysis. But if you're not sure, you can just go back to the lesson on market analysis and marketing plan formulation. And then we spoke about how you formulate your marketing plan by looking at the market mix, which is your 4 P's, which one is product, 2 pricing, 3 place for promotions. So we have guided you in terms of what you need to do when you're developing your marketing plan to make sure that you price your product correctly and suitable for your target market. You place your store or your operation where it will be convenient for the operations. It might be for the customers or for the suppliers, whichever one that is key for you. So you need to put or set up your operation in a way that it will be accessible for your important people, which are your customers and your access to raw material. So those are the main stakeholders that you need to ensure that where you put your operations, if you put it online, if you build a physical store, if you put it in the industrial area or in up marketplace, it needs to be guided by the logistics, your supply chain processes, your customers. How you're going to service your customers, how you're going to bring in raw material if you are in a manufacturing sector. So that's now the market analysis and the planning. That's the lesson, but it's a full lesson. You can, if you go into the platform, then you can go to the market analysis and marketing plan. You can now learn more about how you can put together how you do your market analysis and put together your marketing plan. So once you've done these 4 components, which is four currently, because we are looking into 1, you identify the opportunity. 2, you did a feasibility study. 3, you've done the market analysis and marketing plan. 4, you've developed your operational plan, how you're going to execute this opportunity. Now you need to go into the numbers, because that's where you ultimately have to conclude if this business is actually viable. Even though you've done a feasibility study, now the numbers is where you prepare the actual numbers to make sure that based on the plans that you've put in place, will this business make me the returns that I'm looking for? And remember as well, you will be approaching the funders, right? The funders, what are they looking for? Obviously, okay, they are maybe your developmental institutions that are more interested on job creation and local economic development. Even those, and the banks are more interested in security and making sure that the money is returned with interest, of course, or with a return on investment. Whoever that you'll be dealing with in terms of raising capital, employees, suppliers, customers, they just want value for money. So for investors, the value for money is the return on investment. So that's what we're looking at. And I would like to believe that even for the shareholders, maybe the founders or the entrepreneur, you want to make a return on the investment that you'll be making. Determine how you will be making money. You need the financials now. You need to know how much funding you're going to need, how in terms of the revenue, the costing. Now you put in the nuts and bolts to your business plan. And remember, each section, the feasibility study will be, even though it's part of the business plan, but it becomes a separate document. Then the operational plan becomes the summary of it, not the full plan, but the summary of the operational plan. Obviously, it will show business model and all that. It becomes the first part of your business. The market analysis and the marketing plan become the second component of it, and the third component is your financials, which is the lesson that I'll be presenting today. So today I'm presenting how to know how much you need, and then you develop the financial projections so that you will be able to submit a full business plan to a funding institution if you're looking for funding, or for you as an investor, the numbers will show you the returns that you will be making from this investment. And then you'll be able to analyze if it makes sense or not, decide if you should invest or not. Now I'm going to start with the funding required before we do the financial projections, and I'll explain what are the financial projections. But first, you need to know the funding that you require. How much do you need for you to start the business? In terms of how much, how do you get the amounts? So the amounts, you'll be getting them from your operational plan. Operational plan will tell you that you need 1, 2, 3, 4, 5 equipment. Yeah? And then what you need to do as an entrepreneur, once you know the equipment that you need to phone around, find quotations for those equipment. Obviously, given the market study that you have done, you should know the capacity that you need to produce, right? If you're selling books, and then you've done your market study, you know how many books you're supposed to produce. If you will be manufacturing them, not necessarily writing them. So you know how many books you're supposed to manufacture per day or per month or per annum. So when you're looking for equipment, you must take into account the capacity of that equipment. Does the capacity match the market? Obviously, with the capacity, you need to make sure that maybe you have you buy machine or equipment that will give you more than the baseline that you're using for the product that you want to produce. What does that mean? It means if you know that based on a market study, you need to produce 1,000 books per month. When you are looking for equipment, you look for equipment that can produce, let's say, 2,000 rand, so that it gives you room for growth. So that when you're growing, you don't have to necessarily buy new equipment. But don't go overboard in terms of buying. You know that your market size is 1,000 books per month. Then you go buy plant and equipment that will produce 100,000 books per month. You know that you are probably, you might get there, but you are unlikely to get to 100,000. Maybe you might get to 2,000 or 4,000, whatever the max. When you're ascertaining how much funding will be required, take into account the capacity of the equipment. And when you're looking at the capacity of the equipment, you are not only looking at one equipment. Remember, an operation is a process, right? You might have, let's say there's one equipment that can do 1,000 books, and you might have another equipment that can do maybe 2,000 books, and then the packaging can do maybe 5,000 books. So it means the equipment that can do 1,000 books, it will be a bottleneck in the system because it's doing the lowest quantities compared to the other two equipment which complete your manufacturing process. So what I'm saying is, you're looking at the equipment that you need. You look at them in totality, or you integrate them. When you look at them, you look at your process flow to say, what do I need in terms of input? What do I need for processing? What do I need for output? Then you make sure that equipment that you're buying, they aligned in terms of capacity that they can produce, so that you don't get a bottleneck. You rather have equipment that are aligned than have one equipment that is a bottleneck, meaning it's holding you back because it doesn't have capacity to produce enough quantities for the other machines. So you need to do a proper operational flow analysis, look at the process, and make sure that the capacity of the equipment that you're buying, they will meet the demand, one. But even if the demand increases, they have more or less similar capacity, so that you don't find one equipment becomes a bottleneck and the other ones you're not fully utilizing them. So find the best targeted production per unit or per customer or whatever. Even if you're building a retail store, you basically look at your market. What's the size of the market? I have people who are going to will be buying maybe 10,000 bread per day. So that means my capacity in terms of the infrastructure, the building, the equipment, I should be able to, or furniture and fittings, maybe not much of equipment if you're talking about a retail store. So you look at this business, can it store, or can I hold 1,000 bread per day? Then if you have that capacity, then you know that this is the infrastructure that you need to put, or books, whatever the capacity that you're looking for. So that's how you determine your capacity and the equipment required. Okay, so it's very, very important for you to understand what is the capacity that is required, so that you are able to buy appropriate equipment which will be able to service your customers. Once you have the equipment, you know which equipment capacity, then you go out and look for quotations. Right. It's advisable. Yes, I understand there are certain equipment that you might not be able to get more than one, or there might be few suppliers, or maybe a sole supplier. So, but where possible, get as many quotations as possible. Not as too many, but 3 quotations are sufficient to show reasonability of the quotations that you have. Because if you have one quotation, you might find that maybe that supplier is not a reliable supplier, because you might find that they're selling you a book producing equipment for 100,000, because but you only find that actually a quality book producing or manufacturing equipment is R1 million. So now, because you only looked or obtained one quotation, you might think that you will be able to set up with 100,000, to only find out that actually you need R1 million, or you need an equipment that is worth R1 million for you to set up. So it's always best to get at least 3 quotations, so that you are comfortable that it makes sense. And then there are certain things that the more you get the quotations, there are certain things that you're going to be able to pick up in terms of the equipment, to say these features, this one doesn't have this feature, this one has this feature. So it makes a very nice comparison. So you go out, you get quotations for the equipment that you need for the business, right? Then it's called capex, capital expenditure. Then you're going to know how much you need for that business. And then after you've done that, you have all the quotations, then you look at your working capital. What is working capital? Working capital is the money that you use to operate the business. Like you need to pay rent, you need to pay employees, you need to buy stock. Those are not assets. You are not buying a physical asset that lasts long. Yes, you might be buying material, but that material you will be using it over a period of a year. So it's not an asset. It becomes a working capital, meaning it's the money that you invest to get the business working every day. Daily operations, they need funding for it. Now, to fund the daily operations is called working capital when you are raising funding. Then once you know what is the capacity of the machine and the size of the market that you'll be servicing, then you know how much raw material do you have to buy for you to be able to service the customers, right? You know, sometimes I know entrepreneurs are a little bit ambitious. They'll think it will make money from the first day. It doesn't work like that. There will be teething problems. There will be ramp up where customers, they don't know about you, and as you operate, they start knowing about you. So you're not gonna hit that R1 million per month turnover from word go. The operations will ramp up because 1, you are not known in the market, but 2, you are also learning the production process, the supply process, the supply chain process of that business. So when you're introducing a new product or you're entering new markets, there is that learning curve. So that's why you need a working capital to finance that learning curve, so that you're not worried about paying employees, you're not worried about buying stock. And some businesses you sell on account. So you find that especially if you're dealing with government and big institution, you deliver, then they pay you 15 days or 30 days later. So in terms of funding, how are you going to fund the stock if you're only paid 30 days later? How are you going to service the next customer if the current customer that you just serviced will gonna pay you 15 days later or 30 days later. So you need working capital to cover you for a period of time. So generally, it's a little bit generous, but be conservative. Maybe plan that for the first 6 months, you're not gonna make money. Then you need to calculate what will be your working capital for that period. Looking at the rent, looking at the employees, looking at the stock that you're gonna need, looking at the debtors. And because you are new, most of the time, there will be no businesses that are willing to give you credit lines. So obviously you need to buy stock cash. So you look at those expenses for 6 months, but obtain quotations, speak to the suppliers to know exactly how much working capital you need. And then it will be the working capital and the capex. So added together, that will be the total funding that you will need for you to start the business, right? So, but if you are not self-funding your business, then from that amount that you need to indicate how much is going to come from your own pocket, how much you want to go out and look for funding for. Yes, unless if it's government grants and maybe it's government initiative, just maybe to uplift businesses in the country. If you don't have such scheme that you'll apply for, you need to be cautious on the amount of funding you need, because even though they won't tell you, even developmental institutions, they want contribution, right? Your NEF, your CIFA, your IDC, they might say when they are in the media to say no, we fund based on viability, lying to you. They fund based on security. Yes, you might have the market that makes your business viable, but they want you to put the skin in the game, so they will put it. Meaning, they will want you to contribute something to the funding that you need. Yes, depending if you are youth and women and people with disabilities, yes, you can get away. You're not necessarily getting away, but you can contribute less than the mandate or what is required by that institution. Meaning that you might, maybe they say if the total funding is R1 million, then put in 10%, which is 100,000. And we know most of black entrepreneurs, they don't have capital to put. So when you're looking at the required funding, don't be too ambitious. You need to make sure that you do what is called a minimum viable product. Meaning, look for funding for minimum quantities, minimum operating cost, minimum. But the minimum that still makes your business viable. So you look at that, you look at the minimum, and then that's what you're looking for when you go into the funder. So that even if they say put 10%, it becomes something that you will be able to put. Because you can be ambitious and look for 100 billion, and then they say put 10%. That's 10 billion that you need to put in. And yes, sometimes it doesn't even make sense to say funding institutions are looking for own contribution. But you must remember that businesses are high risk, right? If an entrepreneur has put the skin in the game, has put something down, they wouldn't want to lose that. So the level of commitment to that business, it hits the roof, because the entrepreneur will know that there's something to lose if this business doesn't work. So if you know there's something to lose, then it will make you think like a business person rather than an entitled individual. Because entitled individual will thumbsuck the figure and think everyone needs to bow down to their demand. But different institutions have different mandates. So you need to make sure that you meet their mandates, but in terms of the funding that you need, you are looking for the bare minimum that is required, unless if you have trust funds and all that, so that you can match their own contribution. And remember, the 10% of that investment is an indicative figure. But the ideal figure, the structure, they call it structure, which means is the debt to equity. Meaning, if the business needs 1 million rand, they say ideally the equity must be 40%, meaning unencumbered money that is in the business. So meaning an entrepreneur ideally must put in, if you need 1 million, then you need to put in 400,000. And a developmental institution will be able to put their balance. Easy. Okay, but we don't have that kind of money. So generally, then you start now looking at the socio-economic benefits and all those things that no, you are in rural area, you are disabled, you are youth, you are a woman, and all those things. So those sweeteners, they can make their own contribution drop, okay, maybe to 10% or whatever the institution. But it's just the indication that if you're looking for funding, don't expect to be funded 100%. You need to put skin in the game. Meaning, don't just thumbsuck the figures. Make sure you do your research. Make sure you get, for all the funding, your funding requirements, make sure that you have quotations for it. All the funds that you need are supported by quotations. That's very, very important, that you need to make sure that. And make sure that you don't buy Rolls Royce, buy your Toyota, buy the reliable, but with minimum capacity that you need to be viable. So that you're not trying to raise a large capital. Because remember, if you are raising funding and you just need 100 billion, to service that 100 billion, you need to make sure that the equipment that you're buying, you're going to sweat it to the fullest. You're going to operate at full capacity. Because if you buy equipment worth, 100 million, but you're only generating, let's say, 100 million in turnover, there are certain expenses and all this, and eventually you might be running at a loss, meaning you wouldn't be able to repay back the loan. So what you need to do, make sure that the equipment that you are buying, you will be able to sweat those equipment. You will be able to operate at maybe 75% capacity, because it's difficult to operate at anything more than that, because equipments break, they need to be maintained and all that. And then even if in the shop you can't operate at 100%, because you still need a space to move around, to be able to pack and to collect customers to fetch their stuff. So you need aisles and all that. So you can't operate it. It's not practical for a business to operate at 100% capacity. So look at the best way to set up, the cheapest way or the most affordable way. And to reduce the capital that is required, you might as well also look at leasing some of the assets that you want to use. Instead of buying, you lease until you have built up the revenue to the level that you can afford to buy. So that's on the funding required. Then you need to determine the capex amount and the working capital amount, and that's the total funding required, and also indicate how much you will be putting in of that money. And when they're doing their due diligence, they'll look at your own contribution. You must be having a proof that you have access to the money that you're going to put in the business. You must put the skin in the game. Because you are not a charity. Yes, unless if you are running a charity organization and you are relying on donors and all that, they might not want you to put anything in there. But if you're looking for a commercial funding, the funders will want you to put something down. So now that something is generally based on how much you need funding for. So if it's 100 million, even if it's 10%, that's 10 million. If it's 1 million, 10% is 100,000. But I'm just mentioning 10%, but the required contribution is much higher than that for viable businesses, remember. And I'm still talking TFIs. I'm not talking banks. Because TFIs are more, they call it developmental funding institutions. So they are more into economic development, job creation, sustainability, you know, those good stuff. So that's why the contribution is as low. It can go as low as 10%. But ideally, it should be 40%. Right. That's now developmental institutions, which are considered to be having a risk appetite, meaning they are willing to take risk, but they won't be taking 100% risk unless you are politically connected or you have secured the market. They're 100% sure that this market has been secured and you just have to deliver and pay them. But for a complex businesses that you need to manufacture bread or produce bread and still go sell it, and you don't have off-takers, even though the market research shows that there is demand, but there's still that risk. So they wouldn't want to take that risk. Or take that risk alone. You need to come along so that if the business fails, you also have something to lose. So that's the approach in when you're raising funding, and this is how you come up with the funding that you need. You look at the capacity that you need to produce based on the market. You look at the full value chain in terms of the production to say, can I reach this capacity? And once you have once you come up with the figure, you get proper quotations, at least minimum 3, to make sure that the figure that you've put down for capital expenditure is reasonable. Then you look at the working capital. You get quotations and all that. So once you have the total funding and you show how much contribution or shareholders or equity that you're going to put in, then you have a structure. Remember I said, the ideal structure is the amount that you're putting in should be 40%. The amount that the developmental institution is putting in is 60. So you have 40%, you are at 40% structure, which is acceptable to many financial institutions, unless there are other things. Remember, there are other risks that they might have identified. But in a vanilla transaction, that structure will work 90% of the time. So that's now on the funding. Then we know how much you need. You need 1 million rand, but you're going to put in 400,000, 600,000 is going to come from the funding institution. All right. Now, when we're doing the financial projections, we need to take that funding structure into account. If it's an equity, you put in shareholding, generally the funding institution will say the term of that loan that you put in, it must not be repaid until they get repaid. So if you put in your 400,000 of your own money and the funding institution put in 600,000, your 400,000, it shouldn't be repaid until their 600,000 is fully paid. So that's okay. That's not cast in stone. There are certain institutions, maybe they might negotiate and all those things, but standard, the money that you put in, it will come out last. The funding institution, they'll want to be paid first, and then you get paid after. That's how it is. I mean, it is your business, so you must stay in for longer than the people who are supporting you, which makes sense. But now that is on the developmental institution side. On the banks, yes, you still have to prove that you have the market, you have the customers, but as well, remember the banks, they generally have access to your banking information. So what they'll do, they'll check your banking, the consistency and all that. They'll check your credit checks, even sometimes for even directors and all that. They'll want to look at the financial statement, the income statement. Sometimes they go as far as requesting the financial statement in the balance sheet and the credit checks for shareholders. And that happens a lot of times. So there are few institutions that maybe they might bypass that. But it happens, then they verify to say, this, you'll be able to secure the loan, and you put it in, and it comes out after they got they got repaid. That's now looking at the funding structure. 40, 60. 60% external loan, 40% equity loan that comes from you. And that equity loan needs to stay in business for longer than the external funding. So that's now on the funding required. So those, remember, the loan that they gave you, they're going to charge you interest. And the interest is going to affect your profitability. You need to repay it. To repay the loan, you're using cash. So it might affect your cash flow. In terms of coming up with the funding required is very important because it might impact the long-term sustainability of your operation. So you need to make sure that you don't, even though you have access to borrow, don't just over borrow if there's such term. So make sure that you borrow a limited amount so that it makes it easier for the business to pay. And as well, why do they want that structure of you putting in equity or 40% equity, 60% debt? It's because even though equity is more expensive, debt needs to be repaid on a regular basis. So equity stays in the business. If the business is not making money, you don't pay dividends to equity holders, right? So it gives the business a leeway if should it go experience financial problems. Then the structure is important to make sure that the business is sustainable in a way that the repayment of the loan are not high, where they also affect the viability of the business. So that's why the structure is very, very important. And then with the banks, it's a different story. They need security. You need to be able to give them assets that will secure their funding. That's the main thing that they're looking for. Other than that, they wouldn't fund you. Your best chances if you're a startup is your DFIs. So yes, that's on the required funding. Make sure you have quotations. Make sure that you buy the minimal equipment that you can get. Make sure that you budget for working capital, the money that will sustain you over a period of time. Then you have the funding required, and make sure that you show how much you're going to contribute and how much you want to source from the funding institution. That's on the funding required. Now we're going to start with the projections. How do you do projections? Okay, now we just discussed the funding required, right? Then we're going to use the funding required to do your financial projections. Doing financial projections, what are financial projections? We're talking income statement, balance sheet, and the cash flow. But I'll just here maybe summarize what are those. But if you want to understand them in detail, then watch or read the learning material on finance for non-financial managers, or finance for managers. It's on our Super Deal Maker program. If you go in there, you'll see finance for managers. Then we explain in detail what is the income statement. We explain what is the balance sheet. We explain what is the cash flow. But here we're just addressing them in the context of the business plan, because you need to put in the financial projections in the business plan. So we spoke about the required funding. You take the figure, whatever you prepare, nice table, you put it in the business plan so that the funder can see how much you need and what you're going to use it for and how much you're going to put in. So when it comes to the financial projections, generally 5-year projections are required, right? And generally the first 2 years you project monthly, meaning you need, when you're looking at the income statement, you need to do month 1, 2, 3, 4 up until month 24. You do your financial projection to say how much you're going to make for those months until month 24. And then after month 24, you can start projecting annually. So your income statement, balance sheet, and cash flow, they can be for a year, for 12 months. So it can be yearly for the next 5 years. But bigger projects, obviously, they are more long-term. If you're building a hospital or you're building a hotel, whatever, then the repayment period will be more than 5 years, surely. Then you do the projection for more than 5 years. But if it's just a simple run-of-the-mill transaction like I don't know, funding a franchise, opening a spaza shop or something like that, then the projection should be 5 years. You must have cash flow, balance sheet, and the income statement. They're very, very important. Those call it items in terms of when you're doing projections. And just to touch on the three statements that you need to include in your financials. Income statement shows you the income that you're going to produce, the expenses that the business is going to incur, including non-cash expenses, which are the expenses like your depreciation, your amortization, those fancy stuff, provisions and all that. Provisions made for bad debt or provisions for legal fees. If you are being sued, you need to make a provision. So income statement shows you the income that you're making minus all the expenses, including the non-cash expenses. So depreciation, those provisions, the write-offs. If you're writing off a car or writing off your stock, inventories, you include in your income statement. Then the income statement will show you if you are making a profit or not, right? And then profitability is very, very important because you must be in the business of making a profit. It's very, very important. You must be in the business of making a profit. So profitability is very important, which is, it comes from the income statement. So you need to make your income statement projections, which shows that the business is profitable. That's one. The second one is the cash flow statement. Cash flow statement is more or less similar to your income statement. The only difference is that cash flow statement is only taking into account the cash that is coming into the business and the cash that is going out. Similar to the income statement, you project it for at least 5 years. If your project is complex and include building and all that, you might project it for over a longer period. The first 24 months must be on a monthly basis. So you show how much cash is going to come in, how much cash is going to go out. For what? So the cash in, it might be for sales, for the things that you're selling. The cash out, it might be your salaries, your raw materials and all that. You show that and you show the cash movement at the bottom. Meaning it must show that the business will be able to generate positive cash flow, which is important. That's what the funder is looking for, to say, can this business produce a positive cash flow? That's the cash flow projections. And you go to the balance sheet now. In terms of the balance sheet shows the position of the business. So balance sheet shows you the assets that the business owns. And then from the assets, it shows the liabilities, meaning the debts that you owe other people, that you're supposed to pay them back. And it shows equity. Equity is the value of the business, which comes from, as you're making the profit is put into what is called equity. So your assets must be equals to your debts plus the equity, the money that is the profit that you've been making, or the money that you've put into the business. So balance sheet just show you the financial position of the business, how strong the balance sheet is. Sometimes I think you'll hear when you're looking at the fund institution, how strong your balance sheet is. The more assets you have, the stronger the balance sheet is for your business. If you have high debts, then your balance sheet is weaker because you find that your assets are more or less the same as your debts. So you don't have capacity. Should the business be liquidated, the funders might not be able to recover their money. Because remember, even if in your books you're showing the assets and the liabilities, but if the business goes under, then those assets will be sold at a discount. So the funder might not be able to recover their money from the assets that the business is holding. So that's why as I mentioned earlier, when we were looking at the funding required, they want entrepreneurs to put in a little bit of skin, a little bit of equity in the business, so that the assets are not close to in value. They are not too close to the liabilities, so that if the business gets liquidated, then they won't be worried that they won't get paid. So what is ideal is that the business, probably the assets will be sold at a 60% of their market value. Even if you sell them at 60% of their market value or at a 40% discount, the funders will still be able to recover their money. That's why the funding structure is important, is to make sure that your business has a solid balance sheet. Then the balance sheet, same thing. You need to project the first 24 months monthly, and the rest you can do them annually, so that it gives the funders a clear picture in the first 24 months how the business is going to be performing. Because remember, the first 24 months are the most riskiest period of your business. The business can fail in the first 24 months. That's why the funders find it very, very important for entrepreneurs to show their projections the first 24 months in a monthly, so that they can see month to month how is the business improving, and then from there on, then they can project per annum. And again, projecting for more than 2 years, it becomes too risky, because you don't know what's going to happen you don't know what's going to happen tomorrow, but you can close to accurately project the next 24 months for a business. The longer you project, the unlikelihood of you achieving that projections. You might not be able to achieve the projections, and you spend time projecting for, let's say, 5 years on a monthly basis. So they make it easier. You project the first 24 months on a monthly basis, and the balance you do it annually for the 3 statements that I've mentioned: income statement, cash flow statement, and balance sheet. And the projections, those projections will be used to see if you will be able to make proper economic return, the return on investment, and you will be able to repay the loan. They are very, very important for the funders, the projections. And the projections must talk to your market. It must talk to your feasibility study. Then, when the funders are able to see that you will be able to repay the loan and make a very good return on investment, that's when they can make a decision to invest in your business. So you mustn't submit your business plan without a detailed funding required sheet, and as well as without the income statement, cash flow, and balance sheet. And if you want to learn more about those, you can go to our finance for managers. Then there we break them down in terms of what is the income statement, what is the balance sheet, what is the cash flow. So you'll see them there in detail, but now I'm just touching them because you need to include them when you're developing the business plan. So now that was our last section in the business development module. Just to recap, we looked at how you identify a business opportunity. We looked at how you do feasibility study. We looked at how you put together a market analysis and marketing plan, how you put together an operational plan, and now we just looked at how you put together the financial plan. So these things combined, they make up your business plan. So you summarize each section to say this is the business opportunity, why you believe is a business opportunity, put it there, maybe as an executive summary. At the back, you're going to attach the feasibility study that you have checked this thing is viable. Then you put your operational plan. It will include your mission, vision, goals, operating processes, organogram, employees required, and all those things, the machine, the operating diagram or operating process. Then you put the market analysis in terms of who you are servicing, who is in the market, and all that. And then you put together a marketing plan. And then from a marketing plan, then you have your financial plan, which it must be detailed projections for 5 years. The first 24 months must be annual, monthly basis, and the rest could be annual. And your financial projections must include the capital that you need, the funding that you need, the income statement, the balance sheet, and the cash flow. Those are very important. And if you've done all this, then you'll have a business plan that is ready to go to a funding institution to support you, or to investors or stakeholders, or for you to use that business plan. Remember, sometimes you develop business plan for different reasons. Even though you are preparing a business plan for the funders, it must still be usable for your business. It must still be strategically important, so that you use the business plan. And it's not, once you develop it, it's not a once-off thing. Make sure that you revise that business plan annually, because things change. You update your financial projections, you update your strategy on all that. Your business plan must be updated annually. Keep it up to date, because it's the guiding tool for entrepreneurs to make sure that you achieve what you want to achieve. And it makes you stay the course. It makes the employees or the stakeholders, everyone, to focus, to know what is expected to be achieved by this business. That is the lesson for today. I hope you have enjoyed. You can, if you want to watch the video again, it's uploaded on Super Dealmaker. And then we also have the learning material that you can read online. And then you can also, if you registered for the course, you can complete your assessments and do your formative, summative, do your projects, do your workplace assignments, so that you can be assessed and deemed competent on this module. I thank you.